Okay, Brian, stay right there. I want to bring in our guest, Andrew Levin, former Fed advisor and Dartmouth College economics professor. We've also got Winnie Cisar. She's the head of credit strategy at Wells Fargo. And Andrew, I'd like to start with you on the very latest here, the headlines that Brian mentioned. No real surprise in terms of no change on the interest rate policy. But, it's going to be interesting to hear what the Fed chair has to say, especially given the trajectory of the virus and the broader economy since the last meeting. Brian just pointing to the statement saying the recovery will largely depend significantly on the course of the virus. What do you think has changed here? I mean, has the outlook changed for the Fed, especially given just the uptick in the virus and the stalled reopenings we've started to see in multiple states?
Well, it's good to be with you, Akiko, and your colleagues. These are tough times, and we really appreciate the Federal Reserve is monitoring the situation very closely. This morning, a new report came out, weekly report from the Census Bureau. It's called the Household Pulse. That indicates that over the last 4 weeks, there's been a drop of 4 million jobs. Okay, so the job market seems like it may be heading in the wrong direction. Probably tied to exactly as you say, the second wave of outbreaks that we've seen in the last few weeks. Businesses that were starting to get ready to reopen and that were actually in the process of reopening, now having to shutter their doors again. So I think that the challenge over the next few months, the best possible scenario is that we have a vaccine later this year. Consumer confidence will skyrocket, and consumer spending, business investment could all recover very quickly, and the Federal Reserve would need to be prepared for that. The worst case is the vaccines are disappointing, not effective enough for a wide range of people, and that this is with us for quite a long time to come. In that situation, things could get worse, and the Federal Reserve needs to be prepared. What would it do in that situation?
Hey, Brian Chung here. I wanted to ask a question over to Winnie. So when we talk about strategies right now amid this Fed environment, it seems like that decision that we just got didn't have anything new in it per se. But when you look at what they've been doing with their liquidity facilities, kind of pushing the timeline back from September to December, does that throw a wrench into the expectation for a recovery in the second half of this year? And how might that change the investment strategy for people watching the markets right now?
So I think that what the Fed is doing is acknowledging that their emergency lending facilities that they set up in March and have largely been acting on already have worked, right? The financial markets, particularly the credit market, in much better shape than they were in March and April. And so we are getting liquidity flowing to the right places of the corporate credit market to prevent this wave of defaults and downgrades. Now, the bigger issue is the economic dislocation relative to where the financial markets are, I think is a much bigger gap than maybe the Fed initially expected in March. I think that the Fed's view was we're going to provide these kind of short-term emergency facilities and give the market the liquidity that it needs to manage through a transitory period of time so that the economy can eventually catch up with the markets. Now, what has changed in that equation is we're having to go through multiple rounds of shutdowns and the virus spiking across the country and across the globe, which means that the Fed is going to have to provide those emergency facilities on a much more extended basis. It doesn't feel great from an investor perspective to have to be buying into a market where the fundamentals feel a lot less certain than they once did. But I think that what investors are going to be looking for is continued faith in the Fed, the continued faith that the Fed is going to be there as a backstop for specific parts of the market, and then also some sort of sign of sequential improvement. Now, the fact that the job market is starting to show signs of deterioration again is personally a bit troubling. But I think that kind of the longer term narrative of sequential growth from a fundamental perspective, particularly when companies can borrow at such low yields, is a sign of at least some stability in the markets going forward.
Andrew, you pointed to the drop-off we've seen in the job market. We've also got the stimulus debate happening, those enhanced unemployment benefits likely to expire before there is an actual deal to be done. What are you going to be looking to hear from Jay Powell when he has that press conference in about 20 minutes or so? You know, Brian already pointed to the fact that the Fed has extended its lending facility through March of next year, but Is there a need for additional support given sort of the economic reality we're looking at right now?
So a big challenge in the last crisis 10 years ago was this gap between what was happening on Wall Street versus what was happening on Main Street. And I think we're seeing exactly the same thing over the last several months. That the Fed's actions and the US Treasury's actions have been great for the stock market, great for corporate bond markets, pretty good for lots of big corporations, and very limited effects for small businesses and ordinary households. More than 2 million small businesses have closed, and many of those are owned by African Americans, by Asian business owners, mom and pop, Hispanic, female business owners. And the employment situation, as I say, is very, very serious. That was starting to recover, but it's still a long, long way from where it was back in January. So the hope again is that a vaccine could provide a very quick boost that would really help the economy get back much closer to normal very quickly. But we have to be prepared. We just have to be prepared for situations where a vaccine takes a year and a half or 2 years or more. And the Federal Reserve and the Treasury and the Congress and all the arms of public policy need to be helping to make sure that Main Street and ordinary households can feed their kids and pay their rent during those months or years ahead before this is all resolved.
Yeah, something we've heard consistently, which is that science and the virus will dictate the trajectory of the economy. We're going to continue to monitor this, of course. Andrew Levin, the former Fed advisor and Dartmouth College economics professor, as well as Winnie, Cisar, head of credit strategy at Wells Fargo. Appreciate your time today. And our thanks to Brian Chung as well.